The initial public offering of India's largest life insurer LIC is finally here, albeit at a reduced size. The IPO is a pure offer for sale where the government is selling a 3.5% stake, down from its earlier plan to sell 5%. It plans to raise 21,000 crore rupees at the upper end of the price range of 902 to 949 rupees per share. That will still overshadow Paytm's 18,300 crore issue. The IPO price values LIC at around 6 trillion rupees or 1.12 times its embedded value of 5.4 trillion rupees at the end of December. The embedded value is a measure of future cash flows in life insurance companies and a key financial metric for insurers. When LIC filed the draft red herring prospectus, experts had pegged its valuation at 2 to 3 times its embedded value based on the valuation of its domestic private sector peers. However, market volatility due to the Russia-Ukraine war may have changed the dynamics. Listed private life insurance companies like HDFC Life, SBI Life and ICICI Prudential Life trade between 2.1 to 3.1 times their embedded value. The average market cap to EV ratio of the three is 2.6 times. If we apply the average multiple, LIC's value would be 14 trillion rupees. The IPO valuation is almost 60% below this level. However, it is in line with the multiples commanded by global peers, which are anywhere from 0.21 to 1.89. Analysts highlighted that LIC had a lower value of new business margin of 9.9% in FY21 compared with private players, who have VNB margins of 22 to 27% due to higher share of participation in group products. Disinvestment Secretary Tuhin Kanta Pandey justified the valuation and timing of the IPO at Wednesday's press conference.
The current IPO is the first step of long-term value creation for LIC shareholders. Government is committed to provide good investment and wealth enhancing opportunity to millions of Indians. This is right-sized considering the capital market environment and will not crowd out capital and monetary supply given the current environmental constraints. This is an opportunity for the Indian consumer to participate in the wealth creation of one of India's most valuable corporation. The valuation reflects this opportunity and the optimal size should provide for a strong demand and aftermarket performance. Valuation flows from the optimizing positioning, devising the best marketing strategy, accessing the investors in the right way and with the right sequencing, structuring the deal appropriately, and selecting the optimal market window. The current dilution is very small in the overall journey of this great corporation. The decision to list now has taken into account the combination of multiple factors, including market demand, which includes solid anchor book, stabilizing market condition, reducing volatility, domestic flows, and corporations' financial performance.
While the government said it has decided to go ahead with the IPO in May due to strong market demand and a solid anchor investor base, there also might be another reason. It has time till May 12 to launch the IPO without filing fresh papers with the SEBI. If this window is missed, LIC would have to update the offer documents with the latest results and embedded value. The government was previously criticized for underpricing the October 2019 IPO of the Indian Railway Catering and Tourism Corporation, popularly known as IRCTC. At the top end of the price range, IRCTC fetched a market value of 5,120 crore rupees. The government divested around 12.5% of its stake in IRCTC during the IPO and sold another 20% in December 2020. Today, IRCTC is valued at almost 60,000 crore rupees, an increase of 1,070% since the IPO. Does the government risk a repetition of the IRCTC episode?
If you see Chinese insurance companies, they trade at about 0.6 times and global insurance companies are at about 1.7 times. Now, I feel it's a right strategy because this is a 3.5% dilution. So in my view, it's a price discovery process. And, Julius Baer is one of the largest private banks, and I can't think of a better defensive buy for our clients at this point of time. So you're getting a risk-free asset with a perpetuity of revenue. So I think, in my view, it's a good move by the government. They've brought the size down to 21,000 crores. So I think it will not even disrupt the IPO market. We'll have a price discovery process. And given the uncertainty in the global markets, you're leaving something on the table for the investors. If you see the market, right, in the last 20 years, the private players continue to gain market share. And while LIC is still the dominant player, but in all the new products, the private sector has a considerable market share. Keeping that in mind, I would still not overprice LIC compared to the private players, because it's just the size. I mean, and for an elephant to move, it takes time. So I think this has been the right approach, because you can't really compare it to the private players, their size, their nimble-footedness, and the market strength of both vary. Like LIC is traditionally strong in UP, West Bengal, in the heartland of India. The newer players are more strong in the affluent areas. So keeping all these factors in mind, the kind of policies that LIC has market leadership on, I mean, it's more endowment-led. I would still take a conservative view on the price.
Another expert echoed similar views.
The point is that I think if you make investor learn, then I think in the following round, investor will come again. And that is a very important point. I think if you don't leave any money on the table for investor, then probably next time I think investor will not come into your IPO. LIC knows it fully well that they will have to come in IPO again. Okay, because of IPO or FPO, whatever you call it as. I think they will have to come again because of the dilution requirement after this thing. So in the current situation, if they are letting the investor earn out of the pricing, I guess I think it's a sensible thing to do. There is no reason to say no to it. I think there will be a higher valuation. Today they are selling at 1.1 times embedded value. I would think that I think they can possibly go up to 2 times embedded value if I think market condition remains very favorable and long-only investors I think walk into it. So that is a possibility, good possibility.
The share price performance of India's current IPO record holder also offers a lesson on what happens when an issue is overpriced. Shares of Paytm, which listed in November last year, are down 73% from their IPO price. Experts feel that the conservative valuation for LIC at this stage is a sensible approach by the government, which has to consider global and local market conditions, long-term return expectations of retail investors, and the nature of LIC's business compared to its private competitors, among other things. They say such attractive pricing will help an IPO of this size sail through easily, even as the markets remain choppy.